Let's also welcome on board Anand Tandon, who is joining us right now. Very good afternoon, Anand, and thank you so much for your time. First up, help us with your take on the markets then, because the trend right now is definitely on the weaker side. Even today, there's been no substantial recovery. So, overall, how do you see the construct of the market, and what are the factors that are playing heavy on the markets right now?
Most of the macro factors right now are not suiting the market. I mean, we are clearly in a situation where the expectation that interest rates will fall is slowly receding. Given where we are with the US yield curve, it is unlikely that the RBI can actually go ahead and cut interest rate dramatically from here without expecting to see a further sharp fall in the rupee, and that can be quite problematic. The macro overall, while the deficit looks at the central level looks good, the state level is not anything great to be talking about. And there is a clear slowdown that is evident in terms of consumption in most of the other sectors. Given where the valuations stand, therefore, there is no great reason for anybody to be buying it other than the euphoria which we saw most of last year. But I think now slightly a somewhat more realistic picture is emerging. Despite that, if you see, other than the commodity stocks, most of the stocks are trading at 60 to 90 times forward earnings, which is hardly the place that you would wanting to buy. So a kind of buyer's fatigue and a bit of a problem with the macro, I think, will combine to keep the market somewhat subdued, if not go down further from here. Uh, that is where I would think the overall picture is. In terms of sectors, I think the only ones you are looking for are, there is a thing about dogs of the Dow. I think that's the kind of thing that you have to be looking at. Sectors that haven't moved, haven't given you any returns for the while, and that too in the large cap, are likely to be the places where there is a better defensive play.
It's the large cap where you can find actually that's actually some of the safe place to be in. But definitely today there's been no recovery attempt, because just yesterday we have seen a very smart recovery coming in, especially in the second half, and definitely coming in for the Nifty Bank, which did end on the flat note. But today there's been no substantial recovery from the day's lowest point, and even the sector churning is not happening much in the last 15 minutes or so. But definitely a lot of these companies from the FMCG pack are doing well, and even apart from that, I do see stock like Zydus Life that is also doing well. Kunal, if you can have a chart check on this particular counter, because just yesterday there was a very positive news on this one, and today as well the stock is seen to be continuing its up move.
Yeah, I've tracked the stock over the last 3-4 years, from a point when the stock was almost at 375 400 towards a breakout about 1250 or 1300 levels, and now the stock after that 1300 mark had gone through a correction. So there was a point, I think, where in the last 3-4 months or so the stock had corrected quite sharply, and that too initially on the back of higher volumes, and then slowly and gradually as the stock cooled off, the volumes ebbed off for Zydus Life. So I believe that after potentially this kind of a news flow and the price action for the stock, you may probably expect the stock to get back into at least a bottom formation over here. So I believe 1000 odd levels, 950,000 odd range could be a good range where traders with a more of a medium term to longish term time frame, they could start to accumulate.
All right, that's the take coming in on Zydus Life, but definitely stock like Swiggy is also in focus today. And Naresh, help us with your view on Swiggy. I believe that the data is not much available for Swiggy, but given a 3% move there, how do you see the stock? And is this a time to like maybe book out some profits or continue to hold on?
So tough to take a technical call given that the data is very less. But if you were to look at Swiggy in terms of the correction, we've seen a decent correction in the near term. Post listing, the base is around 420 to 480 was the trading range. So I would expect 480 to be an important support going forward.
480 could be the important support level when it comes to technical levels for Swiggy. So let's watch out for that. But definitely on the news flow, IGL is the counter that is in focus, as the gas allocation has been increased by 31% from January 16. Definitely positive news flow coming in, because when the news flow did hit that the gas allocation, APM gas allocation will be cut, the stocks were actually hammered, impacting the volume growth. And in lieu of that, we have seen companies also taking some bit of a price hikes in order to cope up for that. But what does it mean for IGL and for other companies as well? Are we in for that particular move coming in from the government? Let's understand more on that. We are being joined by Deven Choksi, of DR Choksi. Hi Devin, thank you so much for your time. Help us with your understanding on this news flow, because price hikes by the companies was something that we were definitely hoping for, but this high allocation of the domestic gas, is it something that is already in the price, or how do you read into it?
Hi, good afternoon. Well, I believe two things have happened in this. One, of course, I think the domestic gas prices are relatively cheap. So comparatively, I think you have a better margin to talk about when the allocation of gas increases from the domestic quota. Here in this case, I think IGL's main say is in the CNG stations, which is about 880 odd stations that they operate with about 98 lakh kg per day kind of a capacity. And the domestic pipe customers, I think, are around 2.5 million. So obviously, I think for their expanded reach to these customers, they would probably require the additional allocation of gas, and that's what I think is going to help them on the volume front. On the other side, the lower price is helping them on the margin front. So it's a win-win. On one side, you have got the volume increase. On the other side, the margin is improving because of the lower cost of gas, and that should reflect well into the books of the company. How much as a percentage of the existing revenue, etc., I think it will be a subject matter of how much volume they will be able to handle it in a due course of time. But in my viewpoint, I think on the whole, it's a positive news. Whether it is completely priced into the stock price, I'm not too sure, because I think it's more of a trading activity. That is what is possibly determined on this particular news basis. But on the whole, I think it is positive news as much as I think in that direction.
Well, definitely, Devin, because it was just on last Friday that ET Now did report that the government has asked stocks like ONGC as well as GAIL to divert some of their gas quotas to the city gas distribution companies, and IGL, being the market leader in terms of the market share, is definitely getting the most of that particular pie. But Devin, definitely, is it something that will come through for MGL as well? Is it that obvious?
Well, I think one cannot rule it out, I think, for other city gas distributors as well, largely because of the fact that I think in order to have gas at a cheaper price, I think to feed the industry, the government's main concern is also to ensure that I think industry gets gas in course of time. Like I think we have a situation that in Morbi, the Gujarat gas has possibly not been able to supply the quota at a price, and because of that, I think some of the units have stopped working. So that is another cause of worry for government, that in such situation, when the industry activity comes down, it affects the growth rate in the economy as well. So it does make sense to allocate higher amount of quota to domestic distributors, so that at least both to the industrial as well as to the household, they are in a better position to supply this gas.
Devin, with this, we'll let you go on that. Thank you so much for helping us with your take on IGL, and definitely it's a win-win that is coming in for all the city gas distribution companies, specifically IGL, and coming through this particular announcement to MGL as well, that cannot be ruled out, but let's wait and watch whether that comes in or not. But let's talk some of the other counters then. Then definitely some of these other paint companies are also doing well today. Just yesterday as well, we have been discussing about the perk-up that we have seen in Asian Paints, Berger Paints, and today even ExxonMobil is also participating in the same. But Kunal, any paint stock that you like at this point in time? Because believe given the market's construct, these stocks are finding some ground there. So Asian Paints and Berger Paints, your chart checks?
Yeah, I think we looked at both these charts today, and especially over the last 2 or 3 days, there is some pickup of volume and price action for both of these names. Berger Paints, I think, has come back about the 470 mark, 465, 470 range, and the last 2 days, the cumulative volumes for the stock is much on the higher side. It's almost like a 2x, 3x volume jump for Berger Paints, and cumulative to the price action. This indicates that there's some sort of buying which has happened for the stock. Same is the case with Asian Paints, where the stock has shown some bit of recovery, coming back about the 2300 levels. But then I think these are hugely underperforming stocks, and coming at a point where the market sentiment is actually not very positive, would probably bring a lot of question mark into the recovery into these stocks, and how far and how strong can the recovery be into these names. But yes, the data over the last 2 days indicates that we could be in for a mild bit of short covering for paint stocks. So I would probably go in with a buy into these names, both Asian Paints as well as Berger Paints, but the risk reward would be almost 1:1 given the market scenarios.
Okay, a bit of short covering, which is at play right now in some of these paint companies, but just taking stock of some of the big movers. There has been definitely some profit booking on alkyl amines as well as Balaji amines, because those stocks were high by around 10% earlier. They have seen a bit of a drawdown in the last few minutes, so there has been a bit of a let up from the highs of the trading session, still holding on to gains, but then materially off highs as well. But in terms of the other big movers right now, of course, Bajaj Auto is up 2.5% on account of that CLSA upgrade. M&M2 has been doing quite well, and Auto as a pack has been fairly volatile, one has to say, because the month of December was quite good for them, in terms of the stock prices, but still question marks as far as the sales data is concerned. But real estate as a pack, that has been coming under pressure. Sobha, Oberoi, these have been some of the names. Anand, what's the sense on real estate? Has it peaked out both in terms of cycle as well as stock price?
I would hesitate to say that it has peaked out, but it is not as if it is very early in the cycle. It is a very mature cycle that you see right now. I think it will probably last another 6 months, 1 year, maybe 1.5 years. In most of the cases, each city is different. It's a very localized business. But to a large extent, given where the prices are today, where after a sharp increase in price and a sharp increase in sales, it is very likely that you will hit some kind of a slowing down effect from here on. More importantly, if the stock market itself were to correct, the wealth creation that has happened here will also affect, a slowing down of the wealth creation will also affect a slowing down of the asset creation in real estate. So, would it be? Are you likely to see one more year of good earnings? I would hazard a guess that yes, it will be. Most of the companies will be reporting fairly decent numbers for the next 12 months. But from a stock market point of view, not necessarily a huge upside from here.
All right, but Anand, also help us with some of the sectors that you are eyeing at this point in time, and those look good given the market correction.
Like I said, it is really I'm looking for defensive sectors rather than those which are aggressively growing, because most of the growth, in my view, will now start to taper off. So sectors that have not done well are the ones you are likely to be finding better places to be in. I think, for example, the banking, the insurance sector are two areas which have not performed all that well. Is something that you might want to look at. From a consumption perspective, the good old staples is something that one can be looking at. You are betting on a better rural recovery, and therefore more money in the hands of the consumer in the rural area. So all the FMCG, traditional FMCG and staples companies have a good runway ahead. Some of them even have international markets where things are looking up, for example, Godrej. So some of these companies are something that you might want to look at. And then there are, of course, individual plays that you could always find, which are difficult to classify in the sectoral thing. The broader themes that you are looking for in the market continue to remain, things like data centers and new technology. But to my mind, it's very difficult to find companies in India which are reasonably priced and have that kind of growth. Uh, for most of the other growth sectors, like for example EMS and so on, I think the valuations are kind of stretched for the numbers that will undoubtedly come through.
Okay, it's difficult to find either the valuation or the growth at a reasonable price. That's something one needs to watch out for. But you're talking about defenses, but I want to put the spotlight on defense as a pack, because that too has seen a bit of a correction, though the visibility remains strong. And my colleague Sumit Chaturvedi got us this exclusive information earlier today as well, that defense is going to be one of the focus areas. And of course, the Minister of Defense called it the year of reforms for the defense pack. Let's quickly take it across to Sumit, and then Anand, I'll take your view on the defense pack.
At a time when global geopolitical tensions are there in many spheres, including Israel, Hamas war, Ukraine, Russia, India is looking to massively spend its or increase its spending on defense. Well, we are hearing from sources that this time in budget, there could be a massive spending on defense. Three areas have been identified. First of all, the capital outlay could be increased as far as defense spending is concerned. It means more projects can be announced when it comes to defense. Second could be more startup schemes or even some startup schemes which are already here. Some tweaking can be done so that more and more Indian startups can participate in this, and a push to exports. That is also one important factor that is in the mind when it comes to defense spending. Also, we talk about more self-reliance schemes that can come under Atmanirbhar Bharat. That's another something that can be on the radar of the government. If we talk about the defense budget for FY25, it was total 6.2 lakh crore rupees, out of which 1.8 lakh crore rupees for salaries and 20%, over 20% was for pensions. So now that is a problem because more and more money has to go towards capital expenditure and acquisition, but it's going towards pensions and salaries. So Indian government is going to now focus more on agile, tech developed modern armed forces, and that's why this spending could be announced. If we talk about a bit about the overall defense share in GDP, it has declined in post-pandemic period, but geopolitical conflicts, they warrant India increases spend. So many more projects could be announced, including some projects for the light vehicles, especially for the Indian Army.
Anand, you heard my colleague. Would you want to bet on defense names and buy afresh?
So, there are various kinds of defense companies. By and large, if you take something like HAL, for example, they can make the body, but they can't make the engines. And we know the story of what's happening with the engines. Nothing has been delivered in the last 1.5 years as far as the new machines are concerned. As a consequence, despite the fact that they have an order book, they are not able to deliver on it. And yet the stocks have rallied to a level where, the evaluations are more than many of their international peers. So, yes, there is no question that the underlying theme in terms of defense spending will remain strong. The challenge remains that you need to get more private sector players into it, and also that you need to move away from just platforms to things which are a little more agile. I mean, today a drone and a cyber security is far more important necessarily than just going on and making a lot more tanks or artillery, for example. So, to the extent that the order books are fairly robust, the companies will have to and have the ability to manufacture it locally. You should expect to see earnings growth. But you have to remember that even today, private sector players are seriously constrained in terms of being able to access the defense market. And until that substantially changes, you will unlikely see too many new startups or innovators coming into the market to deliver. So it remains a very strong theme, except that India is not the best market to be playing it. You should be looking at investing in the US.
Perhaps India is not the best market when it comes to defense. Thanks, Anand, for making time and speaking with us today.